Have you ever wondered what happens when a tidal wave of money hits an already explosive market? We're not talking about a ripple. We're talking about a tsunami. And it's heading straight for the world of crypto. The vehicle for this massive shift, crypto exchange traded funds, or ETFs. Buckle up, because we're about to explore how crypto ETFs are set to unleash the next wave of institutional money, potentially reshaping the entire financial landscape by 2026. So, what exactly is an ETF? And why is it such a big deal for crypto? Think of an ETF as a basket of assets. Instead of buying just one stock, you can buy a single share of an ETF that holds dozens or even hundreds of different stocks. It's a simple, regulated, and familiar way for people to invest. Now, apply that concept to cryptocurrencies. A crypto ETF allows investors to get exposure to digital assets like Bitcoin or Ethereum through their regular brokerage accounts, just like they buy shares on Apple or Tesla. No need to worry about private keys, digital wallets, or navigating complex crypto exchanges. It's crypto investing made easy and, more importantly, made accessible to everyone. The approval of the first spot Bitcoin ETFs in early 2024 wasn't just a minor news story. It was a seismic event. For years, the crypto industry had been knocking on the door of traditional finance. And with this, the door was finally kicked wide open. Why is this so significant? It's all about legitimacy and trust. When major financial institutions like BlackRock, Fidelity, and ARK Invest were talking about firms that manage trillions of dollars launch their own Bitcoin ETFs, it sends a powerful message to the market. Crypto is here to stay. It's no longer a niche asset for tech enthusiasts. It's a legitimate investable asset class recognized by the biggest players on Wall Street. This stamp of approval is crucial for attracting the real heavy hitters, institutional investors. We're talking about pension funds, insurance companies, university endowments, and sovereign wealth funds. These organizations manage colossal amounts of capital, but they operate under very strict rules and risk management protocols. Before the ETFs, investing directly in crypto was often too complex, too risky, or simply not permitted by their mandates. The ETFs change all that. They provide a regulated, secure, and liquid pathway for these giants to allocate a portion of their portfolios to digital assets. It's like building a superhighway where there was once only a dirt track. Let's look at the numbers because they are staggering. In the first few months alone, the spot Bitcoin ETFs attracted tens of billions of dollars in inflows. This initial surge was just the tip of the iceberg. Many financial advisors and institutional platforms have a due diligence period, often lasting 3 to 6 months, before they can recommend or add new products to their platforms. This means that a lot of the big money hasn't even entered the market yet. As these platforms complete their reviews and begin offering crypto ETFs to their massive client bases, we can expect a second, and likely much larger, wave of capital to flow in. And it's not just about Bitcoin anymore. The recent approval of spot Ethereum ETF has opened up the floodgates even wider. Ethereum, with its vast ecosystem of decentralized finance, NFTs, and smart contracts, offers a different value proposition than Bitcoin. Its inclusion in the ETF wrapper signals to the market that regulators are becoming more comfortable with a broader range of digital assets. What's next? It's not hard to imagine a future with ETFs with Solana, or perhaps even a diversified basket of top cryptocurrencies. Each new ETF approval will create another on-ramp for institutional capital, progressively integrating the crypto market with traditional finance. So, what does this all mean for the market by 2026? Let's paint a picture. Firstly, expect significantly higher market caps for major cryptocurrencies. Basic supply and demand tells us that when a massive influx of new money chases a limited supply of assets like Bitcoin, SFIX 21 million coins prices tend to go up. This isn't just retail FOMO. It's calculated, long-term allocation from some of the world's largest financial entities. They aren't day trading. They're investing for the long haul, which could create a much more stable and sustained upward trend for the market. Secondly, we'll likely see reduced volatility. One of the biggest criticisms of crypto has always been its wild price swings. While volatility won't disappear overnight, the presence of large institutional players can have a stabilizing effect. These investors often act as a stabilizing force, buying on dips and providing a solid floor for prices. As the market matures and becomes more liquid, those heart-stopping 50% drops could become a thing of the past, replaced by more orderly market behavior similar to what we see in stocks or gold. Thirdly, this integration will spur a new wave of innovation. With more capital and legitimacy, crypto projects will have more resources to build and develop new technologies. We'll see more sophisticated financial products built on the blockchain, greater real-world adoption of decentralized applications, and a stronger bridge between the worlds of DeFi and traditional finance. This influx of institutional money isn't just passive investment. It's a catalyst for growth and development across the entire crypto ecosystem. The line between Wall Street and crypto will become increasingly blurred. Looking ahead to 2026, the crypto landscape will likely be almost unrecognizable from what it was just a few years ago. The narrative will have shifted from a speculative gamble to a strategic portfolio allocation. We will see financial advisors recommending a small percentage of crypto exposure to their clients as a standard diversification strategy. Pension funds will hold Bitcoin alongside stocks and bonds to hedge against inflation. The conversation will no longer be IF institutions should invest in crypto, but asterisk, how much asterisk? The crypto ETFs are the key that unlocks this future. They are the bridge connecting the trillions of dollars in traditional finance with the innovation and potential of the digital asset economy. The next few years will be absolutely pivotal. The groundwork has been laid, the gates have been opened, and the first wave of institutional money is already here. But the real tsunami is still gathering strength just over the horizon. By 2026, we won't just be talking about the next wave of institutional money. We'll be living in the new financial reality it creates. The world of finance is changing right before our eyes, and crypto ETFs are at the very center of this historic transformation. Thank you so much for watching. If you found this deep dive into crypto ETFs and the future of institutional investment helpful, make sure to hit that like button and subscribe to the channel for more content like this. What do you think the crypto market will look like in 2026? Drop your thoughts in the comments below. See you in the next video.